Welcome to my Trademastermind channel. Today topic: stock market history and introduction. Where did it start? In the 1600s, the Dutch East India Company became one of the most powerful trading entities in the world. In the 1600s, the Dutch East India Company, a prominent shipping and trading. They take a ship from their country, travel to another country, and trade materials such as gold, spices, silk, and clothes. Their primary work involved taking goods from their own country and selling them in other countries, facilitating international trade. The Dutch East India Company, with its fleet of hundreds of ships, aimed to maximize their trade potential. Instead of focusing on a single destination globally, they chose to visit multiple locations, expanding their reach and increasing their opportunities for profit. When you visit multiple places, you can acquire a variety of products to sell in your home country, increasing your profit margins. However, operating a ship comes with significant risks. At sea, there are many dangers, such as storms that can damage or even break the ship. Maintaining the ship is challenging, and the constant threat of accidents, natural disasters, or other unforeseen events adds to the risk. Maritime trade, while profitable, is fraught with uncertainties. Similarly, maintaining these ships comes with very high costs. Sending numerous ships to different countries significantly increases expenses. As a result, it becomes challenging for banks or financial institutions to raise the necessary funds to support such large-scale operations. During those times, the Dutch East India Company took an innovative approach. Instead of relying solely on banks, the company turned to the public. They reached out to ordinary people, explaining their business model. The company would travel to different places, trade goods, buy and sell products, and generate profits from these activities. Let's say the company makes a profit of 1 lakh from a single ship. If people invest money in the company, instead of sending just one ship, they could send 10 ships and potentially make a profit of 10 lakhs. The company assured investors that, regardless of the amount they invested, they would receive returns proportional to their investment. What did the company do? They went to the streets and shops to collect money directly from the people. In return for their investment, they offered a share of the profits. The idea was simple. The company would conduct trade using the ships, and if the ventures were successful, they would share the profits with the investors. For instance, if a ship went on a profitable journey, the investors would receive their share of the earnings. When the ship returns to the country and brings in a profit of 10 lakhs, the investors share in that profit. If someone invested 1 lakh, their share of the 10 lakhs profit would be proportional to their investment. For example, if the total investment was 10 lakhs and the profit was 10 lakhs, the profit would double the initial investment. So, if you put in 1 lakh, you would receive a return of 1 lakh profit on top of your initial investment. This turned out to be a very lucrative business. What did everyone start to do? People began investing in ships, each wanting to be a part of the profitable trade ventures. By the 1600s, the Dutch East India Company had a major breakthrough. Instead of buying shares in individual ships, they offered shares of the entire company itself. This allowed investors to own a part of the whole operation and benefit from all the trade profits, not just those from a single voyage. The Dutch East India Company was the first to issue company shares in the 1600s. This groundbreaking move allowed them to raise funds from the public. By selling shares of the company, they were able to secure the capital needed to expand and develop more business ventures. This not only fueled the growth of their trading operations but also set a precedent for modern stock markets. Other companies soon took notice of the Dutch East India Company's success and began to adopt this method. They realized that issuing shares was a profitable business strategy and started trying it themselves. This innovation led to the development and growth of more businesses. Today, this practice has evolved into what we know as the modern stock market, where companies trade shares to raise capital and grow their operations. Now, Let's understand why companies issue shares and what the reason behind it is. Imagine a hotel named ABC, which is a popular restaurant known for its excellent food, whether it's biryani or any other dish. Because of the quality of the food and service, this hotel has attracted many customers and become well known. As the hotel's reputation grows, the owners may need more funds to expand their business, improve facilities, or open new locations. By issuing shares, the company can raise the necessary capital from investors in exchange for a portion of ownership and a share of future profits. Because of the quality and taste of the food, the hotel has become very famous. People from 10 kilometers, 5 kilometers, and even farther away come to eat at this restaurant. Customers often tell the owner, "Your hotel is far from our area, but if you were to open a branch closer to us, you would still have a steady stream of customers and business." Similarly, opening a new branch would be convenient for both the customers and the hotel. Many people enjoy dining at this restaurant, but because it is located far away, they can't easily come and go. The management of the hotel realizes this and starts considering opening a second branch. However, starting a second branch comes with its own costs, such as expenses for construction, staffing, supplies, and marketing. Let's say the cost to open this new branch is 10 lakhs. While the hotel is generating income, it doesn't have enough cash on hand to cover the expense of opening a new branch. To fund this expansion, they need to raise money. If they can secure the needed investment, this new branch will help the business grow even further and increase profits. To start this new branch, they need 10 lakhs. Who can they turn to for funding? One option is to go to a bank to get a loan. Another option is to seek money from family or friends. These are the two main sources of funding, correct? If they go to a bank, the bank may require a lot of conditions or collateral, and if they don't meet the bank's requirements, it can be difficult to get the loan. On the other hand, asking family or friends might be easier, but it can come with its own challenges and expectations. If the bank rejects their loan application due to strict requirements, or if they don't have a strong financial background, and if their family can't provide the 10 lakhs either, they need to find another source of funding. The hotel owner realizes that if they can secure the 10 lakhs, the new branch will lead to increased income and higher profits. The third option is to go to the public. They can raise money by issuing shares to investors, allowing people to invest in the business in exchange for a share of future profits. If the hotel owner invests in the new branch, there will be increased sales and more customers coming to buy. To raise the 10 lakhs needed, he decides to hold a meeting to ask for investments. Let's say he wants to find 10 partners. He plans to contribute half of the 10 lakhs himself. So, out of the total 10 lakhs, he will invest 6 lakhs. For the remaining 4 lakhs, he needs to find investors to share in the investment. Now, 10 people come forward as investors. These 10 friends are interested in investing in the hotel because they see its potential for growth and profit. To raise the 4 lakhs needed, each of the 10 friends decides to contribute an equal amount. If the total investment needed is 4 lakhs, then each friend invests 40,000 rupees. Each person is investing 40k, and collectively, they contribute the 4 lakhs needed. Now, the hotel owner has raised the full 10 lakhs. He uses this money to open the second branch of Hotel ABC. After starting the second branch, the business becomes successful, generating a profit of 1 lakh after expenses. Now that the second branch has made a profit of 1 lakh, the hotel owner needs to decide what to do with this profit. It's important to remember that he is not the only owner of this branch. The 10 friends who invested are also partial owners, sharing in the profits. The owner and the investors are now discussing how to use the profit. They decide that to grow the business further, they need to allocate 2 lakhs for marketing to increase sales and attract more customers. If they decide to divide the profit, the hotel owner and the investors will share the 1 lakh profit based on their investments. The owner, who invested 6 lakhs, will receive 60,000 as his share of the profit. The 10 friends who collectively invested 4 lakhs will divide their share equally, receiving 40,000 each. This means that everyone gets a 10% profit on their initial investment. To maintain transparency, the investors may want proof of how the 4 lakhs was used. The hotel owner would need to show them evidence of the expenditure, such as receipts, invoices, or financial statements, to verify that their investment was used for the new branch and its operations. In this scenario, to provide proof to the investors, the hotel owner will issue receipts to each of the 10 friends. These receipts indicate that they have contributed 4 lakhs in total and that each friend is entitled to their share of the profit. The receipt given to the investors is known as a share certificate. A share certificate is an official document that serves as an agreement, confirming that the investor has given 40,000 to the company in exchange for a stake in the ownership and a share of the profits. This certificate represents their ownership in the company. Each of the 10 investors gets a share certificate showing their ownership in the business. They each invested 40,000, totaling 4 lakhs. When the business makes a profit, the investors receive their share. For example, if the profit is 1 lakh, each investor will get 4,000 as their portion of the profit. Now, let's look at the profit. Each investor gets 4,000 rupees as profit. We call this profit a dividend in the stock market. So, when you hear in the news that a company has announced a dividend, it means they're sharing a part of their profit with the shareholders. This means the company has made a significant profit this year or in this quarter. The profit is shared with the shareholders. The process of giving this profit to the shareholders is called a dividend. In the next video, I will explain this step by step. Hotel ABC decided to sell shares to 10 investors instead of opening more branches. By selling these shares, they transferred part of the ownership of the business to the investors. The original owners kept 40% of the ownership, while the remaining 60% was given to the investors. This process of selling shares to the public for the first time is called an initial public offering, IPO. Let's note what an IPO is. Initial public offering, IPO, means the first time a company offers its shares to the public. This allows people, including you and me, to buy shares in the company. By participating in an IPO, I can also invest in this company and become a shareholder. We can learn more details about this process. The company will allocate shares to different types of investors, such as retail individual investors, RIIs, non-resident Indians, NRIs, domestic institutional investors, DIIs, and foreign institutional investors, FIIs. I will cover these topics in more detail in the upcoming videos. In an IPO, we can see what happens and who the participants are. Now, let's look at the market structure. In the initial public offering, 40% of the shares were given to these 10 investors. This process of selling shares to the public for the first time is called an IPO. This whole process is called the primary market. When a company announces an IPO and sells shares to investors, it is known as the primary market. In simple terms, the primary market is when shares are sold directly from the company to the investors. Now, let's look at the next scenario. These 10 investors see that the company is growing well, and the new branch is doing well. Each investor invested 40,000 rupees, for a total of 4 lakhs. One investor's friend asks about the company's progress. Since the branch is growing and making more profit, the value of the shares is expected to increase. Now, let's consider a friend who is not an investor but part of the public. Suresh asks Ramesh, I know you invested 40,000 in the company, but I'll give you 45,000 for your share. Will you sell it to me? Ramesh thinks about it and decides he needs some money, so he sells the share to Suresh for 45,000. Now, Ramesh sold his share to Suresh, who is another investor. Ramesh did not sell the share back to the company. He sold it to another investor. This is called the secondary market. To recap, primary market, when shares are sold from the company to the investors, like in an IPO. Secondary market, when shares are bought and sold between investors. Primary market. This is when a company sells its shares directly to investors for the first time, usually through an initial public offering, IPO. Secondary market. After shares are issued in the primary market, they can be traded between investors. The company is not involved in these transactions. The price of shares in the secondary market is determined by supply and demand. Dividends. Dividends are a portion of the company's profit shared with shareholders as a reward for their investment. The amount paid per share is called a dividend and can vary based on the company's earnings and the board's decision. Historical context. The Dutch East India Company, VOC, was the first company to issue shares to the public in the 1600s. It set the stage for modern stock markets and the concept of initial public offerings, IPOs. Trust in the market. The stock market operates on trust. If a company performs well, more people want to buy shares, driving up the price. If a company is losing money, investors may not be willing to pay a high price for shares, affecting the share value. Investor behavior. If a company is doing well, investors may pay more for shares, expecting higher profits. If a company is performing poorly, investors may only want to pay a lower price or avoid buying altogether. These transactions between investors in the secondary market are how. Thanks for watching. Trademastermind channel. Subscribe and like, share your friends.